Hello, everybody. How's everybody doing? Sorry, I couldn't make it last week because I was sick. So today we want to continue what we talked about 2 weeks ago. When we were talking about TCJA, the Tax Cuts and Jobs Act, we said that Trump keeps pushing for TCJA to get extended because it is set to expire this year. And we said that there is a lot of planning involved had these tax cuts not extended or expired. Planning would definitely be different in either scenario. And we talked a little bit about what's TCJA. We talked about what does that mean, what tax cuts, what was happening before and what happened after. And this week we want to focus on the planning. How should we plan if it gets extended, and how should we plan if it gets expired? Again, that's why 2025 is a very crucial year, because based on whether this bill would pass or not, planning for 2025 would change dramatically. All right, so let's dig in. Let me share my screen and we'll start. And yes, as you know, I like to start with a joke. Just type this here and let's get it started. I wish complaining about taxes was tax deductible. Wouldn't it be great? All right, so how should we plan our taxes in 2025 if TCJA expires? We're gonna run the two scenarios. So we'll start with if TCJ expires, and let's start with the first point. First thing, accelerate income into 2025. Why? Because if tax rates increase next year in 2026, then we should better consider recognizing more income in 2025 to take advantage of the lower rates, because we said TCJA, it's all about lower rates, whether on the corporate level or the individual level. So if it expires, if the bill doesn't get extended, then we better accelerate income into 2025. Number two, maximize TCJA era deductions, like the 20% qualified business income, the QBI section 199A. This is set to expire. This we've never heard of before TCJA. This was something new and it's totally related to this law. So if it gets expired, we lose it. And what is that? We said that this is a 20% deduction on any pass-through income that you get from your like corporations, from your even Schedule C, from your to make up for the lower corporate rate. So if you're not a corporation and you have another type of business, you get to deduct 20% of your net profit in addition to any other deductions. So this is set to expire, so we better take full advantage of before it's gone. And if you're itemizing, then you consider accelerating deductions like charitable giving, mortgage interest, medical expenses before the deduction rule changes. Because if you remember last time, we said that if it gets expired and under the old rules, some itemized deductions are limited in some instance, in some income thresholds. So you may want to accelerate the deductions in 2025 in order for you to not to be subject to these limitations. Bonus depreciation and expensing. Also, the 100% bonus depreciation is already phasing out, because we said it started at 100% and it keeps going down. It's going to be 40% in 2026, but it's still more favorable through 2025. Like it's this year's 40% in 2025. All right. So if it gets expired, then we better make use of it before it's totally gone. If you plan to buy new equipment, vehicles, machinery, then we should consider making those purchases before the end of the year to maximize depreciation deduction. And instead of taking the deduction over 5 years or so, you get 40% right away in 2025, and then you deduct the remaining in next year's. All right. What else should we consider? Estate and gift tax planning. The federal estate tax exemption is at historic high, about 14 million per individual in 2025, and this will likely drop significantly in 2026, or would go like to pre-TCJA limits if, of course, taking the inflation in consideration, if TCJA expires. So this is at historic high right now, so we should consider gifting assets or setting up trust before the exemption shrinks, because if we gift assets above the limit, we may be subject to gift taxes. So in order to avoid that, we better take like set up trust or start to give tax before 2026 hits. What else? Review retirement contribution and Roth conversion. If tax rates increase in 2026, then Roth conversion in 2025, while rates are still lower, might make sense, because when you convert, then it's kind of like you're taking distribution without the penalty. So you're paying taxes on the conversion on whatever amount you converted. So if the rates are still low this year, so Roth conversions may still make sense in 2025. What else? Consider capital gain harvesting. So same with all with the income tax rates, also capital gain rates will increase if TCJ expires. So if we have highly appreciated assets, it may be beneficial to sell before 2026 to lock in the lower tax rate. State and local tax deduction planning, as we said, that SALT or state and local tax are currently capped at 10K, and this may change after TCJA expires. It would change for our benefit. It would go back to not being capped or not being limited. So if you anticipated changes, you might want to time in the property taxes and estate tax payments strategically based on what's going to happen in the coming couple of days or month, who knows. All right, what else? To review the business entity structure, because if you operate as a pass-through entity, you reevaluate if converting to a C Corp or another structure may make sense post TCJA expiration, or like if is it beneficial for you now? And I keep saying this, and this is the first thing I start with these Facebook Lives to talk about business entity structure. This is the first strategy you should really consider. You should know whether the entity structure that you have for your business is the optimal structure, the one that brings you the highest savings, because not all structures are made to be the same. Everyone is different based on their situation. So you have to assess whether your structure is ideal for you and whether it's bringing you the most savings. All right, so now let's flip and talk about what if TCJ get extended? What would stay the same and what may change? And that's what they're pushing for. So it will kind of say the opposite of what we were saying in the last slide. So first thing is lower individual tax rates will continue. That means there is less urgency to accelerate income into 2025. Actually, if they brought the corporate rate lower from 21 to 20%, then you may want to delay some of the income to 2026 if you have a corporation. All right. 20% qualified business income, same thing. If extended, then pass-through businesses can continue benefiting from this deduction, so there is less pressure to maximize it before 2025 ends. Bonus depreciation. If 100% bonus depreciation remains, you can continue to spread large purchases over multiple years instead of rushing to claim it, to claim the deduction in 2025. Actually, you may want to delay these deductions to get better than the current 40% rate for 2025. Meaning, because they said that they may like put back, like do it retroactively, the 100% bonus depreciation. Now it was phasing down until it's 40% in 2025. It may go back to 25 to 100% effective January 1st, 2025. And in this case, then we may want to delay any deductions until we know for sure what's going to happen at this time. And if it's back to 100%, 2025, then go ahead and buy it. If it's 100% 2026, then maybe delay it to 2026 and so on. But again, if you said, okay, it's extending, but it's not going back, so it's gonna be keep phasing down. So 2026 at 20%, then you better buy it in 2025 and to take advantage of the 40% versus the 20%. So it really all depends on what's gonna happen. All right. Estate and gift tax exemption. If the higher exemption stays, then there's less urgency to make large gifts before 2026 because situation would stay the same. Roth conversion is case by case. So, and all what I'm saying honestly is case by case. If rates stay low, Roth conversion might still make sense, but they may not be as urgent in 2025 as they would be if rates were set to go up again. Review business entity structure. No matter what, you need to review your business entity structure. If the corporate tax rate stays at 21%, keeping a C Corp may still be advantageous for your business. But for others, S Corp or LLC or partnership might still make like a big benefit or might still make sense for them, depends on their circumstances. Strategic capital gain planning, same as we said, if long-term capital gain rates stay the same, then you don't need to rush to sell investments in 2025 since rates are going to continue to be low. State tax consideration. So in all what I'm saying, some state tax laws may change regardless of federal updates. So you gotta stay informed on a state level it changes. A lot of states have their own rules that are different, and you kind of need to make adjustments and see if it makes sense from both federal and state points of view. We talked about this last time, the proposed tweaks with the extension. First, removing the SOL cap, going back to 100% bonus depreciation, as we may have referred to it in this presentation, and corporate rate to go down to 20% or 15% for companies manufacturing products in the US. All right, hopefully you have found this to be bringing you some light into why this matters, why this conversation about extending the TCJA matters, and why it's a big deal, and why this would affect you on your individual and on your business tax return, because it's gonna make a huge difference, and planning according to what's gonna happen is gonna make a huge difference. So keep an eye on the news, keep an eye, we'll keep you updated on what's going on here and how you better plan. And thank you so much. See you next week.